My top 5 trading strategies for consistent profits are not secret formulas or clever tricks. They are battle-tested approaches that survived multiple market regimes because they are built around behavior, structure, and risk control rather than prediction. And I want to be very clear before we go any further that none of these strategies will make you rich quickly, but every one of them can keep you profitable slowly if you respect what they demand from you, psychologically and operationally. I did not learn these from books or courses. I learned them by losing money first, then noticing which patterns of behavior stopped the bleeding, then noticing which of those patterns continued to work when conditions changed, and my ego was no longer allowed to drive the process. The first strategy is trend continuation at higher time frames, and this one alone took me years to stop underestimating because it feels too obvious to be powerful. In my early days, I wanted reversals. I wanted to be early. I wanted to catch the turn and feel smart. The market punished that desire relentlessly. What finally worked was aligning myself with the dominant direction on the daily or weekly chart and waiting patiently for pullbacks that showed reduced selling pressure rather than trying to predict exhaustion. This strategy is not about buying strength blindly. It is about buying weakness within strength. The consistency comes from the fact that trends persist longer than logic expects, and when you size correctly and wait for structure, you don't need to be right. Often, you just need to avoid fighting the tape. This strategy taught me humility more than anything else, because it forced me to accept that being late and right is far more profitable than being early and wrong. The second strategy is range trading at well-defined extremes, and this only works when you are disciplined enough to do nothing most of the time. Ranges are where beginners lose the most money because they trade the middle, chasing noise and reacting emotionally. What worked for me was defining clear boundaries on higher time frames and only engaging when price reached areas of repeated rejection. This strategy is not about predicting breakouts or reversals. It is about exploiting the market's tendency to oscillate when neither side has control. The edge comes from selectivity and patience, not frequency. Most of the time you watch, occasionally you act. The profits come not from brilliance, but from refusing to participate when the odds are unclear. The third strategy is breakout continuation with acceptance, confirmation. And this one is commonly misunderstood because most traders treat the breakout candle as the signal. That mistake cost me years. What actually worked was waiting for the market to prove it could hold above or below a key level after the breakout. I stopped chasing initial moves and started waiting for retests, consolidations, or volume confirmation that showed acceptance rather than rejection. This reduced the number of trades dramatically, but the quality improved just as dramatically. The consistency here comes from avoiding false breakouts, not from catching every real one. This strategy only works if you are comfortable missing moves and letting impatience pass without acting. The fourth strategy is mean reversion in overstretched conditions, but only when combined with strict risk limits and clear context. Mean reversion is dangerous because it feeds ego and the desire to call tops and bottoms. The only way it became profitable for me was by restricting it to specific environments, extended moves into higher time frame levels, climactic volume, and clear signs of exhaustion rather than simple oversold indicators. Even then, size had to be small and exits had to be fast. This strategy taught me respect for risk more than anything else, because when mean reversion fails, it fails violently. The consistency does not come from how often it works, but from how little damage it does when it doesn't. The fifth strategy, and the least glamorous but most powerful of all, is doing nothing until conditions align, which most people don't even consider a strategy, even though it saved my career more times than I can count. cash is a position. Waiting is an edge. There are long periods where none of the other 4 strategies apply cleanly, and forcing trades during those periods is how consistency dies. I learned to define conditions under which I am not allowed to trade: low liquidity, unclear structure, emotional fatigue. And during those times, my only job is observation. This strategy produces no immediate profits, but it preserves capital and clarity so that when real opportunity appears, I am able to execute without hesitation or fear. And this habit alone is what allowed all the other strategies to remain profitable over time, because it kept me from diluting them with bad trades taken out of boredom or frustration. What ties these 5 strategies together is not the setup, the indicator, or the market. It is the behavioral discipline they enforce. Each one limits frequency, defines risk clearly, and requires patience that most traders are unwilling to practice consistently. I did not become consistently profitable by finding better strategies. I became consistently profitable by trading fewer strategies better and removing everything that encouraged impulsive behavior. And that realization is where this conversation needs to continue next, because understanding what these strategies are is only half of the equation. The real work is learning how to choose which one to apply in which environment, how to size them differently, and how to avoid blending them together into a confused mess when emotions rise and results become uneven, and you feel the urge to abandon structure and improvise just to feel in control again. And that is exactly the point we pick up from next, as this sentence carries forward into how to operationalize these strategies into a simple decision framework that keeps them distinct, disciplined, and effective over the long run without turning your trading into a constant guessing game driven by recent outcomes rather than probability and preparation, by imposing a simple hierarchy that tells you which strategy is allowed to operate and which ones are forbidden in any given environment, because consistency dies the moment you let all 5 compete with each other inside your head. The first operational rule that made these strategies work together was environment classification before execution. Before I ever think about entries, I decide what the market is offering: trend range transition or chaos. In a clear higher time frame trend, only the trend continuation strategy is permitted. Everything else is off the table. No mean reversion ego trades, no range fading, no breakout chasing. In a well-defined range, only the range strategy is allowed, and trend continuation becomes noise. This sounds restrictive, but restriction is what prevents you from rationalizing bad trades when conditions are unclear. The second rule is sizing by strategy, not by confidence. Each strategy carries a different risk profile, and treating them the same is a hidden form of overexposure. Trend continuation can tolerate slightly larger size because invalidation is clearer and moves are smoother. Range trades require smaller size because failure is binary and breakouts can be violent. Mean reversion is always smallest because when it's wrong, it is wrong fast and far. Breakout continuation sits in between, with size increasing only after acceptance is proven. Doing nothing has the largest allocation of all because it preserves capital and decision quality. This differentiation alone stopped my P&L from being whipsawed by strategy hopping. The third rule is confirmation over anticipation. Each strategy has a specific confirmation behavior that must appear before execution. For trends, it's reduced counter pressure on pullbacks. For ranges, it's repeated rejection at extremes. For breakouts, it's acceptance after the break, not the break itself. For mean reversion, it's exhaustion plus failure to extend. If the confirmation is not present, the strategy is not active, no matter how tempting the setup looks. This rule eliminates most emotional trades because it replaces gut feeling with observable behavior. Another critical operational rule is temporal separation. I do not decide which strategy to use while price is moving fast. Strategy selection happens during preparation, not execution. During live markets, I am only executing the plan already chosen. If conditions change enough to invalidate the active strategy, the correct response is not to switch strategies mid-session, it is to stop trading and reassess later. This single habit prevented countless impulsive losses caused by trying to adapt in real time when emotions were elevated. Review and feedback are also strategy-specific. I don't evaluate performance by total P&L alone. I review how each strategy performed in its intended environment. Was trend continuation taken during true trends or late transitions? Were range trades taken only at extremes or drifted into the middle? Were breakout trades filtered properly or rushed? This granular review shows you where discipline slipped without blaming the strategy itself. Most strategies don't fail, execution discipline does. The final operational layer is knowing when to deactivate everything. When volatility spikes, structure breaks down, or my own mental state is compromised, the only strategy that remains active is doing nothing. This is not a fallback, it is a core component. Many traders understand this intellectually, but violate it emotionally. I learned to treat inactivity as success in hostile environments. Capital preserved is opportunity deferred, not opportunity lost. When these rules are followed, something subtle but powerful happens. Trading becomes quieter. Decisions feel less dramatic. You stop asking, "What should I trade?" and start asking, "Is my allowed strategy active?" That shift removes a huge amount of internal conflict. Consistency emerges not because you found the perfect setup, but because you stopped sabotaging good ones with the wrong behavior. That is how these 5 strategies work together without collapsing into chaos. Not through brilliance, but through boundaries. If this framework resonated with you, I invite you to subscribe to the channel so you can keep building a trading approach that survives real markets, and leave a comment sharing which strategy you tend to misuse most when emotions rise, because awareness of that tendency is often the first step toward turning a good strategy into a consistent one, instead of another idea that works only when conditions are easy.